Welcome to another episode of the Capital Gains Tax Solutions podcast, where we believe most high net worth individuals and those who help them, they struggle with clarifying their capital gains tax deferral options. Not having a clear plan is the enemy, and using a proven tax deferral strategy, such as the deferred sales trust, is the best way for you to exit your highly appreciated asset, find some diversification, some liquidity, and grow your wealth. I'm your host, Brett Swartz. Each episode, I'm joined by some of the best real estate, financial, business, and wealth minds in the world, where they share their ideas, deal stories, and inspiration. So together we can make complex tax deferral strategies simple and passive income plans achievable. I'm excited about our next guest. He's a repeat guest. He is the CEO and founder of Untitled Capital, located in Southern California. Before his time there, he's been over 30 years of experience, and he's worked with many of the largest and most sophisticated institutional and private investors in investment strategy, portfolio management, and asset allocation. At the end of 2008, he retired as executive vice president with Pacific Investment Management Company, known as PIMCO, to rejoin the UC Irvine Merge School of Business as adjunct professor of finance and create Untitled Capital Management, LLC. From 1999 to 2006, David was head of PIMCO's account management group in London, where he built a team of 25 investment professionals, managing over 200 client accounts and approximately $50 billion in assets across the UK, Europe, and the Middle East and Africa. Please welcome to the show with me, David Young. David, how are you doing today?
Doing great, Brett. Thanks for having me on again.
Excellent. Yes. Thanks so much for being here. And for those, again, who are just learning about you for the first time, maybe give the 60-second version, because we did have the first episode where David dives in, but give the 60-second version, and we'll dive right into the topic today, which is this: what to do when market fundamentals are undeniably out the door. And in particular, talking about the GameStop recent in the news and some of the market fundamentals. But let's start with your story first, David.
Sure. Yeah, we can be brief and hit the high points. Actually, like many young folks is coming out of college, I didn't really know what I wanted to do. I had a degree in economics and political science just because I was really interested in them, but that was kind of a passion. Ended up getting a job. It was actually Rockwell International. This is way back when there was a Rockwell International. And it was working in the finance department, and I got the job through a friend and all that, and it was a great place to start. And this is during the mid '80s. Yes, I am that old. And the bull market of the '80s was well underway, and I decided to leave and go to Smith Barney Harrison Upham. It's one of these old venerable names on Wall Street. It's been bought and sold, and names changed a number of times. But I went to Smith Barney. That was in the mid '80s. Left after actually the market crashed in '87, went back to business school, got an MBA, and I really had decided then that investments and portfolio management, money management was my true calling. Left to join a small investment boutique, and then from there found my way on to PIMCO, Pacific Investment Management Company, and it was a great experience both here in the U.S. and abroad. And came back after I guess it must have been sort of 2006-07, if I recall. A few years in the home office, and decided that it was time to leave. And some folks came and joined me and started Untitled Capital Management back then. And it was really about taking that institutional quality of investment management, making it available to financial intermediaries, wealth managers, and others. Just being able to spend more of every day doing the things we really like to do, and less of every day doing the things that we just had to do. So
absolutely,
we're all on that journey somewhere, right?
Yeah, well said. And for those who don't know, Capital Gains Tax Solutions offers the Deferred Sales Trust, and Untitled Capital has signed a strategic alliance with the estate planning team, which Capital Gains Tax Solutions is a member of. And as a team, we all help you execute on a deferred sales trust, or help your clients do the same. And that's the beauty of what Robert Binkley's been able to do with the estate planning team, and what we try to achieve with David Young and his team at Untitled Capital, and then us as the trustee for the Deferred Sales Trust, to help you map out a wealth plan and mitigate risk and make sense of tax and investments and all these things. Before we dive into that, though, I want to talk about today's topic, which is what to do when market fundamentals are undeniably out the door. And so David recently wrote an article, and it says, what's a game stonk? And so David, tell us what's going on with GameStop, some of the mechanics of what's happening right now in the world of post-COVID-19, and walk us through, some smart decisions to make here moving forward.
Yeah, happy to do so, Brett. I think so. A lot of people came back and said, "Oh, you spelled GameStop wrong." They didn't get it, I guess. So that's good. That was not my title, by the way. We have some folks here who are under the age of 35, 40ish, and I've discovered they think a little differently than we do. So they came up with that one. But yeah. So what would I say about GameStop? And we can talk a little bit about the overall.
Yeah, talk about what happened or what's happening,
yeah.
Right? And then let's dive into that. Yeah.
Here's what I would say is short selling is very common. If you sell a stock that you don't yourself own, which is perfectly okay, then the bet is that it will go down and you will be able, right, and then you'll deliver the stock, right? You would have sold it at the higher price, you'll deliver it at the lower price. In the middle, someone's got to borrow the stock to complete that transaction. You may not know that. Your broker, Charles Schwab, or whoever does that. So without getting too much into that, the point of short selling is not new or different. It's been around for a very long time, even as far back as probably grain and meat futures and frozen orange juice. Who knows how far back? Short squeezes when one side realizes that there's a tremendous short interest, right? And they're going to start buying up the stock, forcing the hand of the other side to kind of capitulate, to exit the trade under very, distressed and much less than ideal circumstances. Not new, happens all the time. This was different though, because we had a couple of additional forces going on. Number one, we have a situation where it was much more public than ever before. Normally, this is an insider's big money hedge fund, institutional pension fund, money manager thing. And please, who wants to hear about that, right? It's boring enough. Number one. Number two, it was different because you had this accelerator of a form of social media, right? Reddit and other online information sources coming together with a very easy, low hurdle, easily accessible avenue. And this is Robinhood. And I don't want to pick on anybody here by names. These are only by examples, right? But you had an easily accessible way to do something about it. And by the way, all of those trades are not free. Your data is being sold, and it's being sold to the other side of the trade. Who else would want to buy it? So beware in this modern era. You are the client, but you're also the product. I think we've all learned that over the last 5 or 10 years, or 2 years if we didn't know it before. So always ask yourself, am I the product or the client? And you are oftentimes both. And so you had that as an accelerator. You also had a low interest rate environment, a very low interest rate environment, whereby normally what happens is the big boys, pardon the use of the masculine, right? You know what I mean, right? They have access to leverage, and they can magnify their decisions because they can borrow very, very cheaply, very inexpensively. Well, now through places like Robinhood and other places with the low interest rate environment, the other side of the trade could also borrow at a very low rate. And so you had this wide access combined with social media, combined with low interest rates, which means it was a levered trade on both sides were levered. Usually the pros are levered and the non-pros are not levered, right? So both sides of the trade were levered, and I would argue even actually further leveraged, right? Just gearing up, ginning up, magnifying of what you were trying to do by the fact that we've never had social media. It was kind of like the hedge funds and the big institutional fund managers and those who speculate, coming face to face with the social media phenomenon coming into as a leveraging factor, right? Maybe even balancing the scales a little bit, coming into what had otherwise been really the purview of the institutional money manager and the pro money manager. Interesting set of dynamics. Probably not the first time that will happen. The transaction is not new or different or special. It happens all the time. But you had all these factors hitting at one time. But I think what's more important is some of the lessons we can take from it when we take a big step back and put it into the bigger picture.
Yes, so much there. And I think that's so interesting. You said the data selling to the other side. and being the product versus being the client. And so be very cautious of that. But its implications are, and correct me if I'm wrong, maybe I'm missing it, but it's almost like I have my cards here, right? And my cards are, maybe two aces, but also maybe no aces, right? And I got five cards and I don't have a hand. If what you're saying, and correct me if I'm wrong, is basically they're showing that those cards, and the other side gets to review that. Is that a fair summary? Or am I missing that, David?
Not 100%. We want to be careful here. We're not trying to say there's any insider access, special, this, that, the other. One side had untoward knowledge. It's not inside information. We're not making any of those, leveling any of those accusations. But data about, as with everything, we've all seen it. At first, I didn't figure it out. I'm online. It's a Saturday morning. I'm shopping for tennis shoes. And I find a nice pair and I buy them, and then I'm happy. And then every time I go online to look for anything, a sports score, the weather, I get advertisements about tennis shoes. It's magic. It's almost like the Weather Channel knew that I just got tennis shoes, and it was telling me to go outside in my new tennis shoes. No, we all know what's happening, right? So we're on to that game. So it's not totally different. I'm not trying to say that every single trade you made was sent immediately to the other team, right? Like they're signaling your trades. It's not like that. But these folks are very, very smart. They have really, really big computers, and they're crunching all this profile data, like who's on these online trading these, some sense of different trading patterns. So there's information content in there, no doubt.
Yeah, you'll be careful about that. So thanks for sharing that. And then the other side about leverage, part of it is interest rates are so low, which is creating perhaps even a more of a perfect storm for these types of environments. So touch on interest rates, and then tie that into the topic, which is what do you do when the market fundamentals are undeniably out the door?
Yeah, I think it's really all scrunched down, and this probably isn't my term. I probably heard it or read it somewhere, and it stuck in my head, and so I will credit the source, but I don't remember who it is. It's the best I can do. But it really feels like, this is sort of the great disconnect. We heard about the great financial crisis, and there was discussions of the great liquidity, and, way back when we talked about the great inflation, and then there was the great COVID market meltdown. Well, this is kind of like the great financial disconnect, right? The real economy is doing one thing. The asset investable stocks and bonds economy is doing another thing. They seem to be doing things very, very differently. I think there are some reasons why. We can talk about that. But it's really about an environment where it's unclear how much damage has been done to the underlying real economy. Yet there's been a tremendous, that's jobs and get up on a Saturday, go to Costco, work all week, that one, right? The real economy that we operate in every day. Then there's this big financial system and financial economy. They seem to be very much out of sync. One, the financial economy is just floating on a gigantic pool of liquidity. More liquidity coming now with additional stimulus and additional, keeping low interest rates low. It's like an asset pump. It pumps up asset values because money's so cheap, you can just borrow and lever. And so you have these two different dynamics, real economy and financial economy, doing different things at different times. And I think the real friction is that, with central bankers wanting to and needing to, and by the way, it's the right policy, keep interest rates, artificially low as part of helping to heal the real economy. The problem is if the real economy doesn't consume that low cost money, that liquidity, and turn it into some productive benefit, then what you end up happening is the money spilling over into the financial economy and pushing up GameStop or Tesla or Bitcoin or stocks in general. And so this is a concern because bubbles can be formed. It's also a concern because normally, we look at fixed income and bonds and debt instruments as being a safe harbor. But with the rates having been so low for so long, money spilling out of the real economy into the financial economy, really pumping up the financial economy, stocks taking off, it's very hard to know what to do in a portfolio especially if you want to have a fairly low or medium risk exposure. The normal safer harbor of bonds, you could argue, is actually quite risky. We've seen interest rates pop up in the last week or so, 15, 20 basis points. That's 0.15, 0.2%. It's not a big number, yet bonds go down 1%. I mean, like that, flash. So that's kind of the great conundrum, if I may, after this great disconnect between the financial and real economy. And I think it's going to be with us for a while.
Yes, so much there. I think you could write a whole dissertation on that. Now I want to focus like a laser on the deferred sales trust and just the value of the DST in times like this. Given everything you just said with the real economy versus, sport spilling over to the financial economy, if I'm a high net worth individual, let's say who owns a high end primary home or business in a highly appreciated manner, right, and my assets are tied to that, what is the value of the deferred sales trust in times like this?
There's two things that immediately come to mind. The first thing is the obvious one, and Brett, you're probably as much, if not more, of an expert on this than I am, which is that initial, resetting of the taxable basis and the original mechanics that make a deferred sales trust what it is, and that's about realizing a transaction without having to realize the full impact of any capital gain, at the moment of the transaction. And you can layer in there a little bit if you want to. From my perspective and the pure investment management perspective, at this point in time, the most powerful aspect is it's probably none of the things that would be a good multiple choice or a good quiz in here. Probably none of the things that would immediately come to mind to your listeners, our viewers. But in my opinion, when the immediate and near-term future is so uncertain, the most valuable aspect of that wrapper, if you will, that transactional wrapper of the deferred sales trust, is that it gives you time. And time is precious when it comes to investing. It is oftentimes the most important single determinant of the outcome, is whether or not you have time to be patient, maybe accept some lower returns now, especially on the fixed income side, wait, live to fight another day, right? But that wrapper gives you time. It insulates the assets, not completely. I mean, the assets are still going up and down, right? But the taxable impact of them going up and down isn't a wave or a volatility you'll feel every day. So what a luxury at a time like now with so much uncertainty to have that nice, big, cushy, insulating wrapper of the deferred sales trust vehicle. It allows me to look at these assets. We manage a lot of them, and say, and not have our hand forced to react today. What we want to do is wait for more better information tomorrow. And it allows us to do that. Is that helpful?
It's very helpful. It unlocks the ability to build a foundation of patience. And I think in our last interview, we talked about having certainty and conviction on whatever investments you're going to be going into, right? Mm-hmm. And part of that would be the next layer is to have patience on that certainty. And if I'm hearing you right, you're saying that DST is kind of like the key to help unlock that, right? Because you're going to be able to sell, let's say, one single asset that's highly appreciated, or you're in a business sector, or you're in cryptocurrency or highly appreciated public stock, that's so high. Capture all of that, move it to on the sidelines in this position where it can be patient money, diversified, fixed income, conservative, sit in the bank for some time, right? I've had some clients sit in the bank for months, we give them some options, but we say, hey, look, you can sit and be patient too, right? Is that a fair summary of what you just said too?
It's funny because I almost finished, but then you were saying laser. And as we know, I don't always go laser. I have many lasers. and so I didn't add it, but I almost said the benefit, the actual impact of that is it gives me the opportunity to identify and take those high conviction positions and wait for the investment thesis to play out. Remember, the number one most scarce ingredient in investing nowadays amongst the pros, in my opinion, and the novice investors is patience. And sometimes we don't get to have patience, but the DST allows us the option of patience, and then it's what do we do with it? And I say we reach higher conviction investment themes. We put them in place, and goodness gracious, can we just let them play out?
100%. And I can't say
Yeah.
that better. And honestly, that's why I started the
Yeah.
company Capital Gains Tax Solutions, is because in 2006, we had a high conviction position that it was time to sell, that the
Hmm.
marketplace was highly appreciated. And it didn't
Hmm.
make a lot of sense for investment real estate owners to 1031 and double down on all of their wealth they built and take on all this debt and be forced into it called a shotgun wedding via the 1031. And
Hmm.
sure enough, we knew that. We knew the Titanic was heading for something, but they felt they had no other option. So, I mean, there was a rare few who sold high and just paid the tax. But a lot of folks, let's say the 80%, they just went for the 1031 and they said it's better than paying the 30 to 50% in tax. But then they paid for it, right? And what we're saying here with the deferred sales trust, it's like a time machine, and that you can kind of freeze time, or you can freeze the market, if you will,
Right.
sit, wait, be patient for that next opportunity, right? Whether it's tomorrow, whether it's 45 days, 181 days, maybe a couple years from now, and then invest. And by the way, let's not put all our eggs in one basket. Let's diversify. Let's get multiple asset types in different dollar cost averaging. And
Hmm.
when you do that, it takes the pressure down, it lowers your risk, and it helps you to create and preserve more wealth. Any thoughts on that, David?
Yeah, I think everything you just said, I agree with. I would actually add that it also lowers the cost of diversification because you can add a few different asset classes, a few more spices to the mix, if you will, that at that very moment might not look especially attractive because because you've got now this luxury of an extended time horizon, which is so powerful. What we also see sometimes in periods like now is it doesn't look logical for the portfolio that's going to be measured in 3 months or even a year necessarily to maybe have as much in fixed income as it should on average over time. But if I can extend that time horizon, it frees up degrees of freedom when I can pursue a little more diversification, which in the end is probably the right thing to do, but it might be very hard to see from sitting here right now. So I would just add that to what you said, but otherwise I totally agree.
Beautiful. Thank you. Now let's talk about estate tax and some of the changes that are going on with the new Biden administration as far as, changing tax policies, which I think only further adds to this uncertainty in the future,
Mm-hmm.
right? You have the COVID-19, still some, uncertainty there. You have political change that's happening and the potential increases in tax and challenges there for businesses. You're in maybe a 12 to 13-year bull run in the marketplace.
Mm-hmm.
So now couple that with the baby boomers and a lot of folks that are ultra high net worth and have this estate tax. I think it's 2025. It's set to expire, meaning the 22 million exemption down to about 12 if you're married, and then if you're single, from 12 down to 6. So just talk about the legacy opportunity, in particular the deferred sales trust, the ability to move it outside the taxable estate, and what that looks like, just for someone like yourself who's worked with ultra high net worth clients in the past.
Mm-hmm. Mm-hmm. Yeah, that's actually you got me there a little bit. I haven't had a chance to give that particular topic a lot of thought. Here's what I would say as an economist and a free market type. My first response is, anytime the government changes tax policy, whether it be, for estate or capital gains or any other sort of, especially investment related tax policy, there's always, first and foremost, there's a bit of a mad dash in positioning to figure out, well, what does that really mean? Will it actually really pass? It's always a question, right? And what does it actually really mean? Then I start to think about, how does that distort? Because it's typically always distortionary. Anytime the government or anybody does anything to intercede, anything to alter your normal rational decision making, and I think consumers and investors are really very rational with their own money. I've seen it time and time again. Purely rational decision making if you just leave them be. So then we get this distortion of rational decision making to try and get around or under or over, and then I think we end up just with typically pretty inefficient outcomes. So. I wish I could give you a more precise answer if you wanted to.
And I kind of asked, it's kind of a long-winded question too, and that's a good answer based upon my long-winded question.
Yeah, no.
Really, it was just this, like,
Yeah.
and I'm not worth the 150 million bucks, right? I'm far from that. But if I were, and I'm saying, okay, 125 is still inside the taxable estate. I've been able to do some gifting, some of it out. Wow, you saying I could sell these assets and move it outside the taxable estate in one day? To me, I think that would be compelling, right? But I also am not in their shoes, right? So just trying to grasp what that means, and then also the legacy to be able to give without having to do the forced charitable giving, right? And control, and I sense, so I say control, I mean your estate itself, to be able to move those funds to different causes you believe in. So I guess it's kind of more of a I don't know what the word would be, a social concern question, right? A legacy play. I'm just curious on how you help your clients navigate that kind of thing.
Yeah, well, here's what we have seen. We've seen a lot of interest in donor-advised funds, where we manage some of them for some banks and trust companies and other groups. So donor-advised funds are a smart way to go, and you don't have to be in that gigantic category. If you're up in the bracket you were talking about, you can have your own charitable foundation, and you can have the whole process, and you can target giving. I think estate planning becomes, we could all agree on this, far more important than it was before. These tax changes, that goes without saying. I think finding the right professionals to give you guidance, and we're shocked sometimes. We are not professionals in this area, but we see the pain that's caused when people don't pick the right professional. It's hard to do. I would encourage everybody to really think very carefully there. We do tend to see the potential for increase in giving, or at least this kind of let's give in a maybe in a more efficient manner. So donor advised funds, community foundations, or other groups that would bring in money in pools, and you can have some steering of the money and where it might go to a whole range of different causes, pre-vetted and overseen. And then I think it just speaks again to the need for something that, because who knows, there's an election in how many months? 18. It's not that far. They'll be campaigning in 12 months, and not to get political, but if you ask my wife, she's counting the days, and you might wonder why. I don't want to go there, but anyway, and so here's the thing that makes it hard too. Who knows what will be in place in just 18 or 24 months from now? So it all seems very capricious. It all seems very sort of distortionary. And so I think, again, the power to, if you have to make a transaction or want to make it, use the right kind of structure, right? Brett and I just talked about some of them. Buy yourself that time that could well transcend the current tax policy. And in 3 or 5 years, we can have an entirely different, set of policies. They can change, and, they could be reversed in no time. So, Brett, I hope that's helpful.
Yeah. No, that's very helpful. With that being said, are you ready for the lightning round?
I'm ready for the lightning round. You have to ask me about a book. I read a book just because.
Well, that's the first question, David. What's the number one book you're reading or recommending right now?
And for those of you who've seen any of this before, it's embarrassing because the only books I read are these really gearhead, finance and economics things. And you want to talk about sleep aid, gee whiz. And so after the last call, I said, I've got to find a real book that real people would want to read. I talked to some friends. They said The Spy and the Traitor. So I got it. I read it. It's called The Spy and the Traitor. It's by Ben McIntyre. He's written a number of these kinds of books. And basically, it's a true story. It's the story of a Cold War era KGB agent named, I hope I pronounced it properly, Oleg Gordievsky. You can Google him. Fascinating individual. I don't want to say too much more because I'll give it away. It's one of those spy thriller, spy craft, lots of intrigue, lots of twists. I think the author does a fantastic job of taking you back in time and making you feel like it was, the 50s and the 60s in that era. I think it'll probably be made into a movie. I've already submitted my name for the dashing MI6 agent, and I encourage everyone to go get it and read it.
Beautiful. The Spy and the Traitor. Second question: What are you curious about right now? Given the, again, I guess we kind of talked about it already, but Curious, what addition are you curious about with the new tax policy or new administration or economy, given that we're halfway through the first quarter now?
Yeah. So what are we watching? And it is a lightning round, so I'll be quick. We tend to watch 5, 6, 7 things that we think really matter, at least as it relates to this question of when will this bull market in investing in stocks end? And we don't know when it's going to end, but we know the recipe for economic expansion, the recipe for bull markets, and the recipe for an end to those. And so right now we're watching, and I'm just going to read off a list here. There's 6 or 7 things. It's excessive valuations, which we're seeing a bit of, a switch in investor sentiment, which we haven't seen yet, but that would be important. Micro market failures, so little failures of proper behavior and functioning in the market. GameStop. Sorry, right? GameStop, we saw that. Fed rate hikes not on the radar. Steepening of the yield curve, so that's the relationship between short interest rate on short-term debt and medium and longer-term debt. We'd be watching that. Asset bubble formation, and then of course a recession is a number one end to bull markets. And if I look down that panel, there's only 1 or 2 things that are red. These little micro market failures will be one of them. There are a couple of other items which are in the sort of orange yellow category, like we're watching so far, so good. The preponderance of in that red, yellow, green light treatment, the preponderance of the indicators are green. So we think, we hope, we believe, we don't know. This is not investment advice. Check with your financial professional. That we think 2021 could be a pretty good year for investors. That's our view.
Amazing. And I'm going to have you back, and we've got to maybe dive into 2 or 3 of those on the next episode, because there's so much meat on that bone that we've got to dive into for our listeners, but we're running out of time.
Yep.
So this is the last question. Just, hey, David, right now, give us an encouragement for investing, and maybe it's wrapping up what you've kind of said. Maybe give us the encouragement on the conviction part. In fact, we touched on it briefly, but taking a high conviction position, what's the number one tip to doing that or practicing that habit for investors right now?
Number one tip for high conviction. Interesting. Well, you see, we have, I think it would be, take your time as you're making decisions, take input from multiple sources. It's hard work. And look at it from a number of different perspectives. The best shield or the best remedy for the risk of this kind of, half-sided, I didn't really think it through, is just to be the opposite. Take time, think through, look at it from a number of different perspectives, and ask yourself, if I'm investing in this because I think it will go up, what has to happen for it to go up? And how realistic is that? And if you can't answer that question and get really comfortable with the answer and maybe bounce it off a few people, and now we have all these different ways to bounce ideas off people, then you're probably missing something. And if it sounds too good to be true, it probably is. Maybe not right away, but in time it probably is. That's how we get to high conviction.
Amazing. Take your time, multiple sources, different perspectives. Critically think, people. Make sure you're thinking and not jumping into something too rash. That being said, David, I want to thank you for being on the show, sharing so much wisdom again with us. I want to encourage you to keep using the gifts and talents you've been given to be a blessing for financial advisors, by the way, who are looking for money managers, because that's really the business David's in. You can go to AnfieldCapital.com. He wants to be part of your dream team to help manage the money for you, so you can spend the most time with your clients and maybe the bigger pictures, and he's going to handle the micromanagement. So you can find David at AnfieldCapital.com. And of course, our deferred sales trust clients, we want to thank you for watching and or hearing this show. Realize that Anfield Capital is a part of the an option to manage the funds in the trust, which is amazing to think about the amount of experience that David Young has, Anfield and his team. That being said, you can go to capitalgainstaxsolutions.com to learn more about that. And or if you're a business professional, go to experttaxseekers.com to learn how to use the deferred sales trust to grow your business with that. We appreciate everybody. Be well, and we'll